Welcome back to the voice of the private sector and the second hour of Brian Bushlach's business briefing, only on FM News 101.
Welcome back, and as you may or may not be aware, some big tax news at the end of 2015 that has a major impact on businesses across the country. I walked down the street to sit down with Michael Lortz at Geffen Mesher and get the download.
Michael, good to see you. It seems like at the end of every year in the past, we were always worried about what would happen tax-wise. Now it seems like things are friendlier. There's some good things happening for business when it comes to the end of the year.
Yeah, we got an early Christmas present this year, Brian. So a week before Christmas, all through the House, we had a tax bill passed. Not only passed, but signed. So December 18th, we had a new tax bill that was put into law. It's called the PATH Act, which stands for Protecting Americans from Tax Hikes Act. Sounds pretty good. Yeah. And it was a little bit of a surprise to me how it all came down. There are some provisions that were extended, some tax breaks, but there's a number of them that were also made permanent, and some that were tweaked, generally in a taxpayer-friendly manner. And what was surprising to me is that a number of these provisions were big-ticket items that have now been made permanent. And earlier in 2015, the administration had come out and said, if any of these breaks are going to be made permanent, then there's going to need to be corresponding tax increases to pay for them. Well, it didn't work out that way, but it was still signed into law, so our clients are pretty happy about these changes.
And these are big changes. These aren't just little token things. These are things that will have a major impact on businesses across the Northwest.
I think they will. I think that one of the major changes that many of our clients will start to look at for the first time is in the area of the R&D tax credit for research and development activities. You know, there's a lot of companies in the Northwest that do things that relates to research, and sometimes they're doing things that are more along the lines of process improvement or design. But many of those types of activities can also qualify for this tax credit.
Talk about the numbers on that, because I think they have split that for different levels of business, right?
That's absolutely right. So this tax credit, it's been getting extended temporarily for years now. It's now permanent, retroactive to 2015, but the big change happens in 2016. In 2016, businesses that have average gross receipts of under $50 million per year, they can now use this tax credit in a new way. They can use it to offset alternative minimum tax, or AMT. And quite frankly, that's a really big deal for a lot of our clients. Let me give you an example. I do a lot of work with professional firms, including architecture and engineering firms. Those firms have design activities that could qualify for this credit. However, generally those firms and their principals are all paying this alternative minimum tax. So there was no real incentive to get these credits because they were still not going to be that useful. Well, now, beginning in 2016, if they are under the threshold, they can use these credits to offset a lot more federal taxes. So these credits are much more appealing now.
You see that $50 million number, and then there's another one below that at $5 million. So there is some help as well for startups and small business.
That's absolutely right. And so the classic example here would be a technology company, perhaps a software firm. You know, there's outside investors that have put money into this company. They're employing programmers. Maybe they're making an app to use for the consumers. Well, what happens is they get a tax credit, but they're not profitable yet. They don't even have any revenue potentially. Well, a tax credit's not much good if you're not paying taxes. But they have employees. They're paying payroll taxes. And so what this new law says, again, beginning in 2016, if their revenues are under $5 million, they meet a couple other qualifications, now they can use this tax credit up to $250,000 potentially to reduce their Social Security and Medicare taxes that they're having to pay as an employer on their payroll.
It's good news. If you're just joining us, Michael Lortz here at Geffen Mesher. Let's talk about this increased Section 179 expensing. Give us the breakdown on this, Michael.
So Section 179 is the provision that businesses use to write off purchases of equipment, furniture, various types of capital expenditures. And in the last several years, we've enjoyed a fairly high threshold. Our clients have been able to write off up to $500,000 of those type of purchases each year. We were concerned about what was going to happen for 2015 because it had dropped to $25,000, a major decline, but this is now retroactively extended at $500,000. It's now permanent in the law, plus that $500,000 threshold is now indexed to inflation. So each year that amount should increase, which when combined with some other recent changes allowing companies to write off a lot of their smaller purchases using other provisions, this will make it possible for many companies for tax purposes to write off all of their purchases.
And so this goes in real estate for TI as well. Is that true?
That's right. So in recent years, on the real estate side, qualified tenant improvements could be written off up to $250,000 of them. That's been extended, but also modified in a taxpayer-friendly way. That $250,000 cap is gone beginning in 2016. It's now $500,000, just like the regular provisions. So that should be beneficial both to landlords as well as tenants.
Talk about the lifespan of these, I guess, write-offs, if you will. It looks like 15 years. I mean, that's pretty gracious, isn't it?
Well, given the recent past, that's absolutely true. So generally, a tenant improvement under the law would have to be written off over 39 years. Frankly, that's longer than most of the leases out there, but it was a very slow write-off period. Under these provisions, those improvements can now be depreciated over 15 years. Plus, if they qualify for this Section 179 provision, they may be able to be written off immediately.
Let's talk about the reduction in S-Corp built-in gains as well. I know this is another key development.
This is, and it's a little bit niche-y, but it's a big deal to a lot of my family-owned business clients who are thinking that down the road they're going to want to sell their businesses. So what this is many of our older corporations were organized as C corporations for tax purposes. And so when those businesses are sold, particularly if it's an asset sale, which many of these deals are, then there's the possibility, a real possibility of double taxation on that sale, which can be a major hit to the family. And this is a big deal. You could lose over 50% of your sale proceeds to taxes in this double tax environment. So one planning technique that's used is to convert that C corporation into an S corporation. And without going into a lot of details, if that planning is done correctly, it's one way to escape the double taxation and to net more when you sell your business. Well, one of the problems with that technique in the past has been that you had a 10-year waiting period that had to expire before you could really benefit in full from that conversion. That 10-year period's been dropped to 5 years. And many of my clients, they might not be planning 10 years in advance, but some of the proactive ones, they are planning 5 years in advance. So it can be very helpful.
Michael Lortz joining us from Geffen Mesher. Last thing I want to touch on here is the exclusion of gains of sale on these qualified business stock. This also helps, doesn't it?
It does, particularly for technology or similar sort of startup companies that are organized as C corporations because they're attracting a lot of outside investors. One of the incentives in the law is to allow those investors to escape tax on the sale down the road, as long as the company remains under certain thresholds. So it's really a way to help the small companies attract investment capital. That provision's been in the law for a while. It gets tweaked now and then. It gets extended. Well, now it's been made permanent.
That's great for business investment all across the region.
Absolutely. Investors drive a lot of expansion in our companies in the Northwest, and this should attract more of them.
Michael, thanks for joining us.
Thank you, Brian.
As always, great insight from Michael Lortz at Geffen Mesher. Now, if you'd like to reach Michael, his email, MLORTZ, mlortz@gmco.com. When we come back, more Business Briefing after a break.